Sasfin has reported a 22% rise in full-year headline earnings and a 23% improvement in its dividend. Joining us to unpack the numbers is Chief Executive Roland Sassoon. Well, Roland, we've spoken many times over the years. Every time you look at the Sasfin numbers, the market likes it because you're a good dividend payer. But intriguing to see your dividend yields below 5% nowadays. So the rating has improved over the years.
Yes, but we're still paying 40% of profits. But yeah, it's a high yield.
Market liked the numbers today, up 4%. So you didn't manage expectations too badly.
Yeah, no, we're quite happy with the results. And I think what we're particularly happy about is the sustainability, we believe, of the results. Because we're really getting it on all fronts. So every unit in the business is now in a profit situation.
We want to talk about David Shapiro's operation in a while because he's probably your most famous person. You're almost as big as the Sasfin brand itself. But the part that jumped out at me is capital adequacy. You've been around a long time. You remember the A2 bank crisis. Is this something still in your DNA that you want to make sure you've got lots of money for a rainy day?
Well, we've got very high capital adequacy, but our growth is strong. So we'll grow into that capital adequacy. And we feel that we've got enough capital to see us through for a few years before we have to do anything about it. But we can now get comfortable, strong growth.
You said in the numbers you got 1.6 billion in surplus liquidity. How much? What does that translate into in your what do they call it? Basel III Tier 1 capital adequacy.
Well, we've mentioned what our capital adequacy is, which is about, I think, 26%. So. There's, as I say, good scope for growth. 26%.
That compares with ABSA at about, I think they were 11.2, yes. 12 point something for 12.2.
But as a small bank, one has to have a bigger capital adequacy.
That's what I was getting to, yes. Because of the A2 crisis, where I guess at that point in time it was pretty scary. You might have worried about being in business or staying in business, because when there's a run on a bank, it's the little guys who get hurt.
Yeah, so we prefer to play it safe and have a strong capital adequacy. And the people who put money with us prefer that as well. So our rating is good and we want to keep it that way. So we don't want to let the capital adequacy drop too much. But as I say, we've got enough scope in capital to see us through for a couple of years, we believe.
As a small bank, your return on equity of 14%, I guess, again, that's an indication of having this lots of cash in the bank, if you like.
Yeah, well, that is a factor. If you go back a couple of years, we were well over 20%, we were well over 25% before Lehman and all the drama that went with that. And we've had to adapt to a new world, and the new world has required, apart from the capital adequacy issue, a lot of regulatory stuff. So we were really taken, it had a big impact on us, the whole Lehman crisis, because first of all we had to draw in or reduce our lendings because we didn't know what was going to happen with the credit crunch. And thereafter, so what happens is the good clients tend to leave you when you cut them back. You're left with the bad clients, then you get a recession hitting you the next year, and then a lot of the bad guys get into trouble. So it took us a couple of years to come to terms with all this. And of course, all the regulatory stuff that's been thrown at us has been massive right across the board in the different businesses. So all this has taken its toll on return on equity. But we're now in a situation where every unit is in a profit situation, and we're getting growth right across the board, and we believe it's sustainable growth. So we're quite confident that our ROE will improve quite a lot.
The cost to income ratio, another thing that we look at in banks, yes. That's very high relative to what we're seeing on the continent. I was talking to a CEO of a Kenyan bank recently, and theirs is in the 40s. You're now below your target of 65%, but it's still around 62, still high.
Yeah. So our model is this, and I think we're unique in South Africa and probably just about in the world, in that we're a small bank with this an enormous amount of products. Over 20 products. So you're not getting critical mass in any one product. But as I say, each product is now in a profit situation. We're now adding critical mass, and so each area should now improve, and that's why that'll drive the ROE up. But we went for this model because we don't have concentration risk. I mean, we know certain small banks who have all their eggs in one particular basket, whether it be unsecured lending or whatever. And then, of course, when that basket goes pear-shaped, your whole organisation goes pear-shaped. So we decided that it would be better to have a diversified operation, and also from the client point of view, we can offer him a diversified service.
And your dividend yield, well, a lot of people buy it for that 4.6, and you are not on a demanding PE ratio either, 8.7 times. David Shapiro, his contribution to your firm, I see that the business that he looks after, wealth management, is up 46% in this year. Did he get a good increase?
Very good.
Is he tied in through equity?
Yes, well, he would be on our normal schemes, and he's, as you say, an invaluable member of the team. My son heads up that division, but David has really helped him enormously. He's the doyen, he's the mentor, and he's just great, and he's also added a lot to our brand. So we're delighted with David.
Indeed. Yeah. And I see that you've swapped a banker, Norman Axton, for what would you call Roy Anderson, an insurance man, a construction guy, a stock exchange fellow, but he certainly isn't a banker. Is there?
Well, he has been on the board, I think, of Standard Bank. He was the chairman of Sanlam. So he's certainly got huge experience. And only half, or just over half of our business is banking. The other half is financial.
So Roy's your new chairman?
He's our new chairman from the AGM, which will take place in December.
Just to have a look at the year ahead, you are the kind of company that people would like to put in their portfolios to sweeten the dividend yield. Is there anything you can give us confidence on that it'll be business as usual in the year ahead?
Well, we're very optimistic about the year ahead. So we believe that what we've achieved is sustainable. We should be able to continue in this vein.